Next guest remains bullish on stocks as he says the implications will move away from the broader averages to become more stock and sector specific. Joining us is Scott Chronert. He's U.S. equity strategist at Citigroup. I don't like specific. I like to just put it in the S&P and not worry about it, Scott.
Well, Kelly, I think the way this is playing out is that we like to, think of that Liberation Day time frame as walking us to the tariff ledge, if you will, where we were concerned about a broader disruption to, many companies' business models sort of across the sector spectrum. And since that time, as we've kind of walked back and we've gotten a little bit more granularity on country by country and the negotiating aspect to this point, the way we're looking at it is that you have to be a little bit wary of reading an entire index level implication to these country-specific tariffs. They're going to have much more direct influence on certain companies, industry groups, and sectors probably than the aggregate index.
Right. But so I found it interesting as well that your, what's it called? Your Lefkovich indicator moved to, in honor of Tobias. Oh, I love that. It was in euphoria territory. You said as of what, Thursday?
Yeah. So, I mean, what we're looking at here is we're getting this next wave of tariff announcements, which is certainly relevant to be discussing in terms of the market action. We're coming off of a really strong move in the broader markets, obviously. The growth cohort has been leading, which is something that we've been advocating for. But what it's done is a couple of things. It's really begun to stretch the sentiment to where we've gone into something, that we would consider euphoric. At the same time, when you look under the surface at what's implied in stocks, our work suggests that you're really beginning to price in an aggressive expectation for earnings expectations from here. And that's going to get tested as a combination of where we end up on country-specific tariffs, but also as we go through the Q2 reporting period, which is just around the corner.
You said aggressive and you said euphoric. Those are not words that would make me feel comfortable as an investor. Have things gotten a little bit stretched, absent today, obviously?
I mean, Brian, in our view, we're using a 6,300 end of the year target for the S&P, 6,500 for mid-26. So we've run up to something that we'd consider close to fairly valued based on what we know about fundamentals. Now, our earnings estimates for the S&P 500 are a touch below consensus. We're 261, consensus closer to 264. We've been arguing for some time now in our modeling that 10% effective across the board broad-based tariffs along with a little bit higher rate for China is appropriate here, but we're going to get nuanced. But my point here being is that, this move has really begun to stretch a number of influences, sentiment, valuation, and even growth expectations. So, color is structurally constructive on the setup as we go into the next back half of this year and forward. But in the shorter term, I think we have to allow for more of a digestion phase, which this tariff news, along with the earnings period, is likely to trigger.